Alrighty, for those of you that are on the live session, if you have any questions during this, since I do have you muted, I will not be able to hear you. And obviously, I'm not answering my phone right now. So if you want to type in the little type box at the bottom, if you have any questions or comments, or if at any time there's a problem with the audio or the visual, please do that to alert me. I may not notice it immediately, but I'm trying to keep an eye on the box. It's on a second screen while we do this presentation. This is residual income requirements for QM loans, and it's effective for applications that were taken on or after January 10th. This is for internal training use only, and information obviously is subject to change. The screen says that the information is current as of 1/10, and actually it's current as of today as well. It has not changed. Oops, no, we really don't want to see calyx there, sorry. So let's talk first about when is residual income required. Clearly I've not had enough coffee yet this morning, folks. If a loan is classified as rebuttable presumption, it has to meet residual income requirements. If a loan is classified as safe harbor, it may require residual income, but it isn't because we've added it as part of this requirement. Residual income could be added depending on agency requirements. For example, VA requires residual income and always has. It could be added because there's an underwriting evaluation issue, or AUS findings in the future may be changed. Right now, I don't believe they're reflecting that, but they could be changed to do that. So those are situations where even if you have a loan that is classified as safe harbor under your QM ruling, it could require. But in general, the only ones that are going to require this are the loans that are classified as rebuttable presumption. And frankly, I'm not certain we're going to get a whole lot of those, but you need to know how to handle them if we do. So let's talk about why is residual income required. The first reason that we've implemented it, of course, is that it's actually a CFPB requirement that if a loan is a higher risk loan, and if you look at the writing in red at the bottom, if it's already considered higher risk, which is one of these rebuttable presumption, that's where it's generally it's a higher DTI, or it doesn't, for whatever reason it's popping into that. Basically, it's what we used to consider the old HPML or higher priced mortgage loans. If a loan is higher risk, the lender needs to have some compensating, excuse me, that should make that go away. I always think I can get it up front and that little message pops up, irritating. Anyway, if a loan is considered to be higher risk, the lender needs to have some compensating factors to offset the risk of the higher ratios. And basically what we're trying to do is, under the CFPB requirements, proving ability to repay. Now, those of you that attended the earlier trainings on QM, when we talked about ability to repay, will be very familiar with that term. And I would recommend, by the way, for those of you that are listening, if you've not taken that training, please contact me and we'll get that taken care of, because you should go through that as well. Some of the items in here, if you still have questions when we get to the end of it, it might be because you didn't attend that training first. But hopefully I'll cover enough stuff that you'll follow it. So CFPB does require that we consider residual income. They don't dictate it, but they say we have to consider it. The second reason that we might have to have residual income is investor requirements. Obviously, those are subject to change. They've changed multiple times in the last month, and subject to variations between investors. So we try to come up with something that pretty much allows us to sell to a variety of investors and sell to most, if not all of them. And finally, it's a risk consideration. We want to make truly sure that whoever we are making a loan to actually can afford to pay it back. And one of the good ways that you can measure that is, at the end of the day, after they pay the mortgage and any other mortgages and any other debts that they have, do they have income left over to be able, to cover if they have an issue? And that's one of the reasons that residual income is required. It's a buffer, basically, to make sure they're not down to, the last two nickels being rubbed together. Residual income in general is similar to VA requirements, or at least the theory is, but it isn't the same as VA requirements. And I'll remind you several times during this presentation, VA has not abandoned their own residual income requirements. You still have to meet that on all VA loans. So this doesn't make that go away. It's like a second layer for VA loans. But the theory was actually established based on the VA requirement. Specific residual requirements are not being dictated by the CFPB. Their regulation literally says we must consider residual income if a loan is classed as rebuttable presumption, if it's a higher risk loan. And as I noted earlier, different investors do have slightly different requirements. Most of them are very similar, and so we tried to come to, I don't necessarily want to say a happy medium, but something that would cover all of them. And most of them were not all that dreadfully far apart. So, and as they change, we will likely, we'll reconsider and change ours also. The one thing that CFPB doesn't do is actually dictate how much residual income you have to have. What I plunked in here, and this is actually new from yesterday because we had a lot of questions on it, so I threw in an extra slide so you guys get additional benefit of this, and this is the one that will be posted on the web. Residual income is the amount of gross income remaining after you take out the total monthly debt obligations considered for loan qualification from the total monthly qualifying income. So the first thing that has to happen is you figure out what the total qualifying income is, and obviously that's up to underwriter interpretation as well. They may disagree with you, but hopefully everybody comes to the same consideration. Then you subtract out all the debts. What's left is considered residual income. So here's an example. Borrower has $3,000 in debts, including subject mortgage payments, and that would be everything for the mortgage, including, for example, HOA. Qualifying monthly income is $4,700, so their residual income is $1,700 at that point. All right, that's how it's calculated. And I did put another note on here. VA still requires their separate residual calculation be completed. It's additional this. And the reason is that VA has not passed their own QM rules yet. If and when they do, hopefully this double calculation for them will go away. Let's talk about what the specific levels for residual income is. Again, remember, it's based on calculated income minus all the debts that are related to this property, other properties, and any other debts and obligations, and make certain that you include alimony and child support if there is any. That's the one thing I know when I was originating, I had to remember to ask people that because invariably they forgot to tell you, oh yeah, I have to pay $800 child support. And sometimes there goes your residual income, so be very careful to be asking about that. Let's look first at residual income chart for owner-occupied properties. And I know this says current as of 1/10. It's still current. There's three columns here. The last column over here is just notes. So the two that you're really going to be looking at, amount of residual monthly income and the reserves that are needed depending on where the borrower falls. So if we're doing an owner-occupied loan, and they have more than $2,500 in monthly residual income, there's no additional reserves based on this rule, based on QM. There may be additional reserves based on AUS or whatever, and you still have to follow that, but we're not layering anything else on. Let's look at the very bottom one because this is one you really need to be aware of. It may impact particularly some of your lower income borrowers. If they have less than $800 residual monthly income, and that is a hard and fast line, we had to draw it somewhere, it's not eligible. The loan is considered to not meet QM guidelines. Now, again, remember, this only applies if you have a rebuttable presumption loan. And those are the ones pretty much that are the higher priced mortgage loans where either your DTI is above 43 or it's outside of the agency guidelines, and it literally is classed as rebuttable presumption. So it's identifying it as a higher risk loan. If it falls into that, then you've got to use these charts. If you get a safe harbor, you don't have to use these charts. So see why I said it's not going to impact every loan? In fact, it probably, frankly, most of the loans I've seen say safe harbor. And if that's the case, you're good to go. But you need to know what happens if you get one that doesn't say safe harbor. If your amount of residual income is $800 up to $2,499, then you're going to need some reserves, and it's the greater of 3 months PITI or the minimum for the particular loan program. So for example, if your AUS says you have to have 2 months PITI, you'd still have to have 3 in order to meet this guideline if their income falls in this range. If, on the other hand, your AUS says 4 and this says 3, to meet this guideline, you'd only need 3. Somehow I have a feeling AUS is always going to be equal to or less than this, so we're probably not running into this 4 issue at all. And please note over here that it says additional reserves may be required by the underwriter, that is, if additional layers of risk are identified in the loan. That's always the case. Underwriters always have to have the ability to, if they see something that's not going quite right or is questionable, they may ask for additional information or additional reserves. But this, at least, this is where you want to be focusing, again, if it falls into rebuttable presumption. The next screen is basically the same chart with different dollar amounts, and this is for second homes and investor properties. And by the way, both of these qualify both for refinances and for purchases because they both fall into that. Now, let's look at it first, and then I'll address this investor property, which some of you are probably going, wait a minute, I thought you said investor properties weren't covered by QM. Well, they're technically not, but let's talk about this first, and then we'll discuss that. The amount of the residual income for second homes and investor properties is a little more clear-cut. It's either over or under $2,500, and actually this box should be $2,500 and above. If they have over $2,500 or $2,500 or above of residual monthly income, there's no reserve requirement beyond whatever might be already required either by the loan program or by DU findings or whatever. If they have below $2,500 in residual monthly income, they're not eligible. This is considered that a loan does not meet QM guidelines because you're already dealing with a higher risk loan, and in that case, you've got to prove that they have the ability to repay. And if they don't have excess residual income on a second home or investor property, it's considered that they don't. All right. Please note the notice down here, what I said about investor properties. Technically, investor properties are not covered by QM. That's correct, and you did hear that right for those of you that were on the training. However, what we are finding is that most investors are still running QM and still require that guidelines be met on investor properties, and that's why this is included. And the reason for that inclusion is that many times investor properties eventually turn into second homes or may in reality be second homes at some point in their life cycle. And because of that and because of the difficulty in identifying what truly is an investor property, unless we get further clarification from our various investors, right now they're requiring that we run QM on all of them, and therefore we have to follow this rule as well. Okay, I have a question. Let me go back. Okay, let me address a couple of things. Todd asked, are the charts universal or are they ResMac policy? These are ResMac policy. However, they are very, very similar to what you will see from lots and lots and lots of other investors. As I said at the beginning, we tried to come up with something that would allow us to pretty much sell a loan to any investor, and they are astonishingly similar from one investor to another. Also, as I said, CFPB did not dictate the specific amounts of reserves, so I think that would probably be what you would call universal. No, that doesn't exist. CFPB simply says that we must consider reserves if a loan is a rebuttable presumption, if it's a higher risk loan. Another question. Can a gift be considered reserves? I had a question on that yesterday, and I have not yet confirmed that answer. I do believe the answer is probably yes, as long as it does not violate anything else to do with the loan. So, but again, the loan would have to be processed and underwritten with a gift being included, even if it's not for closing costs. But again, I've got to confirm that. So I will do that. I had that question yesterday. Don't have a confirmation of it yet. I do believe if it's allowed, it would be. Now, obviously, investor properties don't allow gifts. So for an investor property, no. Second homes and primary residences, you can get gifts under certain circumstances. And I believe if it doesn't violate the loan program itself, it would be acceptable. So let's go on. By the way, these charts will be out on a README probably later today. And this will be available as well as a presentation for your reference. Let's talk first about FHA requirements, because FHA is a little bit different. They, if you remember from the QM presentation, have actually passed their own requirements. And because of that, they have a little bit different way of classifying safe harbor versus rebuttable presumption. So I don't honestly think you're going to get a lot of FHA loans that fall into rebuttable presumption. You'd have to have either small loan amount with a high interest rate and a lot of fees in order to do that. Because if you remember back to QM, safe harbor classification for most loans is APOR plus 1.5 compared to your APR. For FHA, it's APOR plus 1.15 plus the amount of the annual mortgage insurance, which right now is 1.35 if I remember correctly. So it makes it considerably a higher threshold for it to get to rebuttable presumption. Please notice the first note about standard guidelines. Sorry about that. I can't set my stuff from popping up on this screen. So, standard guidelines for the list of compensating factors. Some compensating factors would be required if the DTI is over 43% and will be required if the DTI is over 45%. Now, what I do need to point out to you is this is not necessarily because of these QM rules. This is something that's already been in place for some time with ResMAC. It's related to FHA underwriting regulations and also insuring requirements. What we do find, if you remember right, when you run an AUS for FHA, it also hits up against FHA's total scorecard. And if it refers total scorecard, then it would have to be a manual underwrite. Well, a lot of times what we found is you get an approve for total scorecard. We close the loan. We go to insure it. FHA runs it again, by the way, at insurance, which is something you all wouldn't necessarily be aware of or involved in, but they automatically run it at insuring. And on higher DTIs, once in a while, we get a refer just because what you put in initially to run it, you put in estimated closing costs, you come really, really close, but sometimes if you're off even by a couple of dollars, you go to insure it, and it goes, nope, nope, it's over the limit. We're going to refer it. It has to be manual underwrite. Well, at that point, you've already closed the loan. That's a little bit difficult if you have not already looked for compensating factors, because now it has to go back to the underwriter and be completed as a manual underwrite. And there's very specific requirements of what is needed for a manual underwrite. So Ron and I sat down when I put this together, and then I ran it by him, and he added a few things. And this is one of the things that he asked to have added in, is that we would need some compensating factors added in. If something is over 43%, it could be required, but if it's over 45%, you're going to see a request coming from underwriting about it. So I didn't want you to confuse it and thinking it was part of this particular requirement. It's not. If an FHA loan is classified as safe harbor, no additional requirements due to QM will be added. There could still be these underwriting things added, but you won't run into additional requirements added or residual requirements added because of QM. If an FHA loan is classified as rebuttable presumption, the residual income per the CFPB would be required, the same stuff we just talked about. And if an FHA loan is classified as rebuttable presumption and it's a manual underwrite, it may not be eligible for all investors. It may require credit committee review. For those of you who are not aware of what credit committee is, it's a bunch of senior managers who who are knowledgeable about credit, and we get together once a week on Tuesdays. We discuss credit issues, including such as establishing these particular charts, and we also go through any really challenging or difficult files that are borderline. They're ready to be declined, but it's possible we can talk about them or appeal files. So that's what we do. And if we run into an FHA loan that's rebuttable presumption, that's a manual underwrite, because of these restrictions, it may have to come to credit committee. So if you hear that, that would happen. Hopefully, that's pretty rare. Like I said, I don't expect a lot of FHA loans to be classified as rebuttable presumption because they have a higher threshold than anything else. I know we had a couple questions. Let me go back and take a look and see if I covered all of those. Dan asked why we would not deliver second to non-owner occupieds to Fannie Direct. We do in some cases. That does not excuse us from following QM rules. And we do have to still consider residual income. So the fact that we have made a policy and established it, and we are kind of looking at it in terms of what our other investors are also requiring, doesn't allow us to drop the policy just because we're delivering it directly to Fannie. CFPB requires we have a policy and that we apply it fairly to all loans and that we do follow it. So even if we were to do that, that does not remove the need, just because we're delivering to Fannie doesn't remove the need for a QM loan. CFPB is also over Fannie. As you'll hear just momentarily, VA and USDA, let's talk about those. Neither of them have issued separate guidance, and I stated this as of 110, but as of today they have not either. USDA I didn't address separately. Basically, I don't think you're going to run into a lot of rebuttable presumption loans with USDA, but you could, in which case they would have to meet the residual income requirements, the appropriate one. And obviously, that would only be under owner-occupied because you can't do second homes or investors under USDA. Same thing with VA. The VA maximum generally is 43% or a U.S. approval, has to meet regular QM requirements. A VA loan that is safe harbor, you don't have to worry about it. You use only VA's residual income requirements and you're fine. On the other hand, if it did hit rebuttable presumption, then you would also have to perform the residual income test that's contained in here on top of VA's regular. It's really unlikely you're going to have any VA loans that hit rebuttable presumption because in general, sellers pay most of the costs, and that's what's going to drive it into being a higher priced loan. Fannie and Freddie, neither of them currently have passed their own customized requirements. They are defaulting to CFPB. If you think about it, it kind of makes sense. I mean, Fannie and Freddie are quasi-government agencies, and CFPB is a government agency. So they are basically acknowledging that, yeah, these are pretty good requirements, and they work with CFPB to develop it. I don't think they disagree with them. So I'm not certain you're going to see anything separate. You will get the agency as opposed to regular if you have a Fannie Freddie approvable loan. And as long as it doesn't hit into high costs, you'll still have safe harbor and not have an issue. But if it does, if it is classified, whether it's classified as agency, rebuttable presumption, or regular rebuttable presumption, that would then qualify where you would have to apply the residual income charts contained in this presentation. If specific overrides are implemented, we will always update our requirements. We're on top of that, and we're keeping track of what other people are doing. But currently, we're kind of right in the middle of the pack. Again, I don't expect this to impact a lot of loans. I don't want you to think that this is going to impact all of your loans or that you have to worry about residual income on all of your loans. You don't, only if they hit residual, or I'm sorry, if they hit rebuttable presumption. All right. This is close to the end of this presentation. However, I'm tagging a second part of the presentation on. So when I close out this presentation, please don't think I'm done. I don't want you to leave, okay? But if you have any other questions, please do type those in. I don't see any more at the moment, but you guys are being really good about asking things, and I like that. So for a quick summary, QM requires considering residual income, and that applies to all kinds of loans that we do. We have to consider DTI. But CFPB did not define specific residual requirements. That's up to the company to set, and based on agency definitions and investors and what we feel is a risk appetite as the company. And in some cases, I said underwriter because they may want to add some additional stuff as we discussed earlier. Residual requirements are subject to adjustments as needed, either because we make a determination or an investor changes. And we want to be as agile as we can be in the market. So I'm guessing that 6 months from now, this probably is going to look considerably different than it does now. Could be wrong, not sure, but we're keeping a close eye on it. If you have any individual situations, please don't hesitate to reach out to Ron and the underwriters, and they'll be happy to go through that. if you have any compliance-related things having to do with understanding this, I'll be happy to chat with any of you. So let me go ahead and move to the next part of this. What I do want to let you know also is that if you've not attended the QM presentation, please contact me and I'll be happy to schedule you for that. And also this presentation, as well as our others, we are starting now to record them, and assuming we get a good recording, we'll be posting that on the website. It will be under policies and procedures, as well as the PowerPoints, and anything else is also posted in that same area. So you can always go out and refresh it if you want to say, what is it she said and what did that do? And obviously when we update it, we'll pull those down and update them. This is something I want to run through really quickly. And this has to do also with the requirement that is effective January 10th. This is the new homeownership counseling form requirement. I talked about it very briefly as part of the QM presentation, but this is a little bit more in depth, so even if you heard that, please hang on here and listen. This one is effective for applications taken on or after January 10th. And for all applications, don't even ask me to justify why, but for all applications, a counseling list is required, but counseling itself is not required unless it's required by a specific loan program. So this is always fun. We're going to give our borrowers a counseling list, which is going to confuse them because they're going to think they have to do something with it, and no, they really don't. It's optional, but the CFPB says we have to give it to them. Okay, so that's what we're doing. So let me run you through how to do this. It's actually really, really easy. It's required for all loans within 3 days of application, 3 business days. It falls right in with the initial disclosures. Keep a copy of the list with your initial disclosures and submit a copy of the list right along with everything else from your loan when you're submitting it to underwriting. If the loan falls out before that, upload it to wherever you're putting it in Calyx along with all your initial disclosures, signed or unsigned, so that we have proof that we did this. So it's kind of easy. And actually, DocMagic has added a document that says a lot of this information and says that the borrowers acknowledge that they've received a notice of this. So that helps cover us, but we also need you to actually print the list to go with that document, and DocMagic does not print the list automatically. I don't know if they're ever going to, because it's based on an optional zip code, and I'll explain that in a moment. CFPB requires that a list of nearby available home ownership counseling agencies be provided to applicants for all federally related mortgages that are covered by RESPA, whether or not they're high-cost mortgages. The interesting thing is they snuck this into the middle of the high-cost regulation. It does exclude reverse mortgages and timeshares. Well, guys, we're not doing timeshares, so you don't have to worry about that one. Reverse mortgages, for those of you that are doing those are brokered out products, and reverse mortgages have their own very specific counseling requirements. So you don't have to do this portion of it if you're originating a reverse mortgage. For everything else, you have to produce this. Now, notice this is federally related mortgages covered by RESPA. Technically, investment properties aren't covered by RESPA, but because all of our investors require that we still meet all of those guidelines, we're simply requiring it on everything because everybody else does. Here's the summary of the requirements. It's really very easy. The list has to be provided within 3 business days of the broker or lender receiving the application, unless you deny it within 3 business days, and you don't have to worry about it. One good thing is multiple borrowers. If there's more than one borrower, you only have to give it to the primary borrower, so that makes life a little easier. You only have to print one rule. Here's the actual rule they slipped it into. The 2003 Home Ownership and Equity Protection Act, the HOPA rule. Now, HOPA has to do with Section 32. That's the high-cost loan. Those are the ones we don't do. But right in the middle of that, they put in this home ownership and counseling requirement for loans even if they aren't high-cost loans. So it kind of slid under the radar for a while. The content requirements for the list, real easy. 10 counselors have to be listed. They have to be based on either the closest to the zip code where the borrower currently lives, not the subject property, but their current address. Obviously, if it's a refi, it's going to be the same. Or another zip code if requested by the borrower. They might want something where they work, or if they're temporarily living, like if they're from New Jersey and they're temporarily living in Florida and they're buying a home in Florida, what would be the point of giving them counseling in New Jersey? So they may say, give us it based on our current temporary residence. That's fine. You can do that. If you pull it for another zip code, just document something in the file as to why you picked that zip code. The list has to include the agency name, phone number, address, website, email address, counseling services provided, and languages spoken. Now the good news is, oh yeah, one more thing, it has to have this lovely little statement in it within the quotes here. All right, I'm not going to read that to you. It automatically prints as part of the list if you pull it from the CFPB site. This is also on all the new forms from DocMagic, which refer people to the website. And the reason that they did that is they put that in place, and even the CFPB said initially they'll accept this list temporarily while everybody figures out how to automatically pull that list as part of their origination documents. Well, I'm not even sure if that's ever going to happen, but it's so easy to pull it off the web that all you have to do is remember to have somebody, and it can be emailed separately from the others. You send the disclosures electronically, and then you follow up with an email or physically give them a list if they're in front of you, and you're done. Just keep a copy to show you did it. Here's how you do it. This, by the way, was on the README that went out on January 10th. There were several READMEs that went out, so look for them. If you missed one, this went out. It has an active link right here that goes to CFPB's. This is consumerfinance.gov, find a housing counselor. This is part of the CFPB site. Comes up and it looks like this. To generate the list, all you do is put the zip code in the search box, click on the green button that's Find a Counselor, and then either print the list or save it as a PDF. And you give it to the borrower along with the initial disclosures and retain and send a copy with the file. This is what it looks like. This one's already filled in because this is actually my zip code. So you search by the zip code, so you type the zip code in here, you click this, which on the website is a green button, and then the stuff appears and the little map appears with the numbers that tie into these locations, and you either print the list or you save it as a PDF right down here. And this is what the first page of the list actually looks like, and here's that wonderful statement that they wanted you to include. And they come up with the 10 closest results. So it's really, really easy. You just have to remember to do it. I'm going to close this and show you the full copy of this just so you see what it looks like. And again, it's one that I pulled up on my zip code. We don't have anything real close, and it rapidly gets farther away. So I wanted to show you this so you didn't worry about it. Look, number 5 is 36 miles from where I live. It gets better. We get into the 50s down here. So anyway, they didn't say they had to be close, just closest. So this fulfills the requirements, and you just put a copy of that. This one's, I think, 4 pages. Just put a copy in with it and send it to the borrower. So that one's really easy, but I wanted to make sure I'd covered it, and since it only took a couple minutes, I wanted to tag it on to the end of this presentation. With that, we are finished with the presentation. I don't see any more questions in here as far as typed in. I am going to go ahead and unmute, and unless you are individually muted, that may make it a little noisy and echoey. But if you have any questions, you're welcome to ask them at that point. If not, we are done, and I appreciate everybody participating, and be happy to welcome you at another training at a future time.